My friends, in this section of our research, we will see how parent is involved in activity of raising fund for the following. First, to meet the fund required for development/purchase of intangible assets. Second, to meet the working capital requirements of subsidiaries. But subsidiaries are not reciprocating the response to parent in terms of 1. Return on investments, and 2. Cash flows. And folks, we will see how this non-reciprocation is creating pressure on standalone performance of core education. Friends, as you can see that out of secured long-term borrowings, more than 50% borrowings are pertaining to parent. Also entire short-term secured borrowings are pertaining to parent only. On an overall basis, the subsidiaries are taking burden of roughly 30% of borrowings only, and rest 70% are in books of core education, standalone. Clearly, this situation suggests that Core Education and Technology Limited, India, is arranging for predominant part of debt funding, apart from being the largest source of equity funding for the group. Now, we will see how funds are used to create fixed assets, and for working capital needs of parent and subsidiaries. Friends, we will analyze utilization of funds in 3 parts. 1. If you observe the working capital requirement in last 3 years, Core on standalone basis is keeping the working capital at a very low level. Whereas, subsidiary companies were maintaining a far higher level of working capital. The ratio of working capital requirement between parent and subsidiaries is in the tune of 1:90 in 2013, 1:20 in 2012 and 1:60 in 2011. 2. The company has invested most of funds in tangible fixed assets, like land, building, computer etc., through core education, standalone. Only very small part of investment in tangible assets is kept in books of subsidiaries. 3. But in contrast to tangible assets, for intangible assets company has invested more than rupees 1,000 crore through subsidiaries. Investment in intangibles in core, standalone, is only around 15% of total investment of group intangibles. Thus, we can say the funds in form of equity and debt is predominantly raised by core education and technology. These funds are kept in core through investment on tangible assets, and transferred to subsidiaries for their working capital needs, and investment in intangibles. Friends, after understanding how fundraising and fund investing are placed within the group, now we will try to understand how non-performance of subsidiaries is hurting Core Education and Technology Limited. Friends, as you can see that in last 4 years, Core had invested in its subsidiaries. 1. As equity investment rupees 1,331 crore. 2. As loan and advance to subsidiaries, net, nearly rupees 80 crore. Total investment in subsidiaries by parent is rupees 1,410 crore, as on 31 March 2013. Now, we would like to share 3 critical observations of DA research team. 1. The return on investment in subsidiaries is merely rupees 68 crore in 4 years, that is a dismal 1.2% per annum return on investment. 2. Still the cash is flowing, as equity and debt investment, from parent to subsidiaries, and even after 4 years this trend is not reversing. 3. It is also surprising that subsidiaries had given rupees 247 crore, as long-term advance, and rupees 415 crore, as short-term advance, purpose and nature of these advances not disclosed, to unrelated parties and not giving the cash back to parent, for clearing the statutory dues and managing the necessary working capital for core on standalone level. Hence, my friends, It will not be unreasonable to say that, investment in subsidiaries is proving as one-way traffic for core, without any significant reciprocation in form of cash and returns, from subsidiaries back to parent.